Hey everyone, welcome back to, no, it's not Tech Tuesday, it's Tech Tune Up with Paul Meeks. I'm your host here in the Bayou in Charleston, South Carolina. On this particular broadcast, I'm always sponsored by and helped very much by my friends at Benzinga. Make sure you check out their Benzinga Pro Tools. You can find all of us here every Tuesday, 11:30 a.m. Eastern Time. And also, I manage a tech portfolio for these guys behind my right shoulder, Harvest Portfolio Management. We are, and I am, easily found. So as you know, in this program, we're not here just to regurgitate the news in the tech sector. I will hit the highlights of the past week and give you some ideas as to why that news is important and also how it can impact other stocks, industries, sectors, and tech around the world. So let's get after it for this segment. As you know, I have been hot on CoreWeave ever since I invested in it as a privately held company. But its recent parabolic, very, very good price action has me a little concerned. I'm in this stock at $48 a share. The IPO about 2 months ago was $40 a share. The price quoted just a few minutes ago was $116 a share. And this company has only announced one quarter, although it was a pretty good quarter, first one out of the box being a public company. But still, even for this company that I highlighted long ago, too far, too fast in my opinion. Now, my issue is because I'm an insider, I cannot sell the stock under the IPO lockup until the end of September. But if you own the stock, you can trade it freely. And what I would do is I would not sell all of it, but I would trim the position. I think the stock's ahead of itself. Next in the news, Snowflake. I previewed the quarter last broadcast, but now I must say I listened to the quarterly webinar live and I like it very much, Snowflake. The problem is it's up on a spike, but I will be going from Snowflake on my hold or watch list to my buy list. It'll have nothing to do with any change in the fundamentals. I'm already convinced on that. But the stock has to come in, give me a better valuation entry. Same thing goes with Palo Alto Networks. There may not be a stock in the tech universe that is more expensive than this one. But again, I like what they're doing. I like their category, but I will not buy it until it comes in a bit. Next, as we always do, we have information on Alphabet, AKA your friends over at Google. And, this is a little bit of a scary story for me, given the fact that I did listen to their Google I/O conference last week. And it's very important for this company to make a very compelling case for what they're going to do in AI, because the narrative is building that AI search is going to take over existing search from Alphabet. Probably the best name in AI search is Perplexity. And I imagine over time, Perplexity AI will go public. And so at this particular conference, it was a 2-dayer last week, the powers that be over at Google did talk about or try to at least push in some way that they could their AI strategy, including you can now search in quote unquote AI mode. You also can quote unquote shop with AI mode. And so we'll see, because the problem is if they don't transition quickly to AI supported search, their core franchise could be in some trouble. And right now it's already last couple of quarters slowed its revenue growth rate year to year to only about 10% per annum. And for a tech stock, unfortunately, that's pretty slow. So OpenAI is gaining a lot of ground. Its most recent series valuation from private equity and the venture capitalist was extraordinary. If this company was to go today, it would probably be about number 20 market cap in the entire United States. It would be very close to the top of the class in the market cap weighted S&P 500. And so they are doing things abroad. as you know, signed a sovereign AI deal, was a big part of the entourage that went around with President Trump just these past few weeks when he visited all these Middle Eastern countries. And as you may have heard, they have bought the company called IO of Johnny Ive. Now, Johnny Ive left Apple in 2019 or so, so he has been alone for a while. But his company might have the lead on building AI consumer electronics that won't be delivered to you in a phone format. It might be something else. And Johnny Ive has a lot of credibility because when he worked at Apple with Steve Jobs, he was instrumental in creating some of their hottest products over time, including the iPhone. So next we have Nvidia. Nvidia has a very big quarterly conference call tomorrow night. I'll be on it. Here's what I think about Nvidia. Now, Nvidia got smacked when Trump on August 2nd announced Liberation Day, just with the rest of the market. The tide sinks all boats. And when the tide sinks all boats, particularly for the very high beta volatile tech companies, they are going to go down worse in the market on a downturn. And luckily, in a bull market, they'll do even better than the overall market. But I think that the stock, now that it's about 135, 136, and it's not too far from its all-time high of 150-ish, I'm a little bit worried as to what they say tomorrow. Because we do know as they ramp a new chip architecture, Blackwell, they are taking a hit on their gross margin. And the narrative had been that their gross margin would have troughed in the quarter that's already behind us. I don't know. I think their gross margin may not trough yet. And I also don't know if we are going to see the second half of the fiscal year revenue reacceleration that all the bulls are demanding. So Nvidia, the largest stock in my portfolio, but I will tell you, I would not buy it before the quarterly announcement. And I do think it's not necessarily a slam dunk that they're going to have a quarterly call in which they do what they typically do, which is not only meet Wall Street analyst expectations, but beat them and guide even higher. A little bit of anxiety heading in tomorrow. Intuit is kind of an interesting company. Intuit does your taxes. Now, I will tell you, while tech is under this pressure, mostly geopolitical related, Intuit may not be a bad defensive or tech stock or tech-ish stock that I like to hide into when some of the aggressive tech stocks are under a lot of pressure. So I'm going to keep an eye on Intuit. If it has any bit of weakness, I'm probably going to buy it as one of my defensive tech names until this whole madness and the smoke clears with the tech sector. Next, Wolfspeed. This is a very sad story. Wolfspeed is a semiconductor company and actually was leading the charge for silicon carbide, which was supposed to be breakthrough technology. I don't know, maybe it still will someday, but in the meantime, they ran out of cash and they're going bankrupt. And I remember not so long ago, within the last couple of years, it's investment bankers who are always cheerleaders for the companies that they bank were saying that this was the next great thing. Well, the next great thing looks to be filing a bankruptcy very soon. Autodesk is another company, blast from the past, kind of like Intuit, that most people wouldn't see as a tech darling. But again, this is a company that supports CAD software. The company's been around since the 80s. But again, they showed a pretty nice quarter relative to the rest of the pack. And this may not be a good long-term hold, but it might be a good, relatively safe tech holding for the time period. So you have Intuit and Autodesk in that category. Microsoft, unfortunately, Microsoft always in the news. And in this time, it's not for a good reason. It's a bad reason. They've had another cybersecurity hack. Apple is up next. Apple is finally showing the strains of the fact that the revenue has not accelerated for 4 years, and it's growing much slowly, more slowly than other tech companies. So that's the rub on the top line. And then also under Trump 2.0 with these tariffs, as its revenues have stagnated because of the tariffs. Its expenses are rising. And Trump will not be satisfied. If they start making iPhones in India instead of China, he wants them in the United States. The problem with that is Apple would free themselves from a proposed 25% tariff if that's the case. But on the other hand, they will never find in the United States a labor force that is so low cost to make those phones profitably. So now your iPhone, which you pay about $1,200 for on the upper end of the product lineup, this is now a $3,000 to $4,000 phone. So I'm really worried about Apple. This is not tactical. This is a secular potential problem. I have sold for my clients Apple in retirement accounts where there is no capital gains tax to be paid. Because I've owned it so successfully for so many years, I've yet to do that in taxable accounts, because there you will generate a capital gains tax, and the cost basis is just still way too low in that name. But I do think this is a really bad secular, not transitory shift for Apple. Nvidia, as I mentioned, they'll be hollering at us tomorrow night. A lot of people like me will be watching. Next is Salesforce. Salesforce is another, I like to say, blast from the technology past. Essentially a company that created software as a service in the 1990s. Unfortunately, their product set is being threatened by AI. And what they're doing today, which is what the company's done for decades, is they band-aid slow organic growth with acquisitions. And they are going to pay several $billion for a company called Informatica. They've been talking to this company for years. I don't think Informatica is anybody's belief that it has leapfrog technology. So again, I think another acquisition for the slow growth, at least organically, Salesforce.com. This stock is not on my software list. I will tell you, on my software list, particularly enterprise resource planning software, which is where Salesforce.com plays, I like ServiceNow and I like SAP. I don't like Salesforce.com. IBM is kind of a funny story. IBM made a lot of news within the last year when they said they were going to fire 8,000 employees because they could be replaced by AI. Well, here we come back about a year later, and they're hiring some of those very same employees back because AI has fumbled taking their very human jobs. So strike one for the human being, and we'll see what happens over IBM. But anyway, a lot of fanfare, now kind of embarrassing. I've told you about Palantir. Palantir, I only buy on weakness. Tesla had some dreadful announcement today. The pain that they're suffering with their electronic vehicle sales in Europe is just staggering. In the month of April, 49% decline year to year in their sales. And now in the meantime, Tesla has come roaring off the bottom. His stock has come so far so fast based on the belief that they will figure out and ramp very, very soon the auto taxi and autonomous driving, and also maybe throw a robot into your home. I'll believe it when I see it, and it'll be a pretty quick test because Musk has said next month of June, by the end of the month of June, they are going to be active with their autonomous vehicles in Austin, Texas. You better believe that this works out because their traditional EV sales have just been horrible. I still think that this stock is probably worth no more than half of where it's trading today. And lastly, because I've talked about this before, even though it's not everybody's frequently mentioned tech stock, is Boeing. Boeing, I have played successfully in the past. They are going to have to pay, unfortunately, over $1 billion to settle prosecution over those 737 MAX crashes from a couple of years ago. But they do have a new CEO. And despite the threat from Trump 2.0 of tariffs, they've announced some very big overseas plane deals recently. And so Boeing might be back on the up and up. I mean, the stock got crushed over the last couple of years. So I'm not buying it now, but I'm watching it. I might return to it because I'm always looking for companies that are non-tech to complement my tech list. And so what else do we have? I mentioned we have earnings this week. The biggie is tomorrow, Nvidia, but also this week, I'll be watching them pretty carefully. You have Dell, and you have Synopsys, and a few other names. And so anyway, we'll see what happens there. I'm always looking for the tells. As of now, I own no Synopsys. I own no Dell. I don't know if I will after these calls, but I do think they will tell us a lot about the AI market and what they see for their customers' continued capital expenditures on AI. So next, let's get to my buy list. Here we go. To make it easier on your eyeballs, what I've done here is I've consolidated. The green grouping are stocks on Meeks Buy List today. The yellows are companies that I'm watching, companies that I may have held in the past. I like them. I like the thesis. However, they are on my stock watch list right now. They are in the bullpen. They are not starting for me on the mound for the New York Yankees. But the stocks that I like, my favorite tech stock today is AppLovin. I like Take-Two Interactive. I'm still invested because of the geopolitical fears in a gold ETF. Alibaba has come on my screen among all of the Chinese AI plays. That's my favorite. I'm still hiding in the electric utility, Duke Energy. As I told you, in AI-oriented enterprise resource planning software, I very much like SAP and ServiceNow and do not like, particularly after this acquisition, Salesforce.com. I mentioned that I'm intrigued by Boeing. Taiwan Semiconductor is still on my list, despite the fact that it always faces a threat from attack from mainland China. I've been successfully hiding in some of these drug distributors like McKesson, Cencora, and Cardinal Health. Genius Sports has been a good kind of under the radar bet for me. Meta, Microsoft, Nvidia, they're the only stocks in the Mag 7 that I will like. I would not buy, as I said just now, Nvidia ahead of tomorrow's report, because I do think there could be some flies in that ointment. I've been interested recently in Lyft, even though I've held Uber for a long time. Uber is a much better company, but Lyft did have a management change. They put up a nice quarter. They have some low-hanging fruit, particularly with cost to pick. And so I just think Lyft is a poor man's version of Uber, but worth buying now because Uber stock has done so much better. I'm interested in Cadence Design Systems. They compete with Synopsys, who is going to report their earnings on Thursday night. I prefer Cadence. And then lastly, I told you about my relative defensive play in Intuit. So we'll see what happens here. But again, the thing that worries me is geopolitics more than fundamentals. I think we have proven through this earnings season that despite worries going in, folks are still going to spend heavily on AI capital expenditures, which makes still valid my AI infrastructure trade, even though I have consolidated my holdings and I'm looking to make a shift from AI infrastructure to AI software. Thus, you see new on the list, ServiceNow and SAP. So let's finish up with some of the tech trends of the day. You know, as an aggressive growth and tech investor, you have to watch interest rates. Interest rates go up, your stocks go down, and vice versa. So I watch the CME Fed Watch tool very carefully, and it looks like we're not going to have any drop in the Federal Reserve Board's benchmark rate until we get probably to the September meeting. That's 3 meetings away, and the Fed meets every 6 weeks. And if you take a look at the odds, even in September, it's kind of a toss-up, 50-50, that they're going to lower the benchmark rate by 25 basis points. They really cannot get aggressive doing that with all the uncertainty about tariffs and the potential for inflation with tariffs that are swirling, not just here in the United States, but all over the world. So the Fed is going to essentially be on standby. On one sense, inflation and or a recession, two things that we worry about, they have not shown up yet in the hard data. But in the soft data, things like consumer sentiment, you're seeing a consumer that has soured here in the United States. And the consumer is very important because consumer spending is 70% of our gross domestic product. So stay tuned. On the quarterly earnings front, again, I was mildly, maybe a little bit more aggressively, modestly surprised that everybody stayed with their AI infrastructure spending guidance. Meta even increased it. But the companies that could be impacted, mostly hardware companies, by the tariffs on China, first of all, we don't know what's going to happen yet because they reported quarters that ended March 31st, and we didn't even have Liberation Day until a few days later, April 2nd. So if your company can be impacted by tariffs because it's significantly importing from the Chinese, no matter what they did last quarter that they reported, no matter what they said about their guidance, they don't know the impact. So unfortunately, some of my questions, particularly around AI spending, were answered, and I feel better about that. But for the massive companies that are importing, particularly from China, I don't think that we even know what's going to happen with these tariffs, and we may not even know until we get into the fall. So unfortunately, expect extreme volatility in those names, stocks going up or down, depending on what Trump says that morning or that afternoon. I still think that there is a pretty good chance that we're going to have a recession in this country just because so much damage has been done ever since Liberation Day. And the problem is when you have uncertainty, if you are a self-respecting CEO or CFO, you are going to put a kibosh on any spending, whether that's on payroll, whether that's on equipment, whether that's on expansion, until you get some geopolitical certainty. So unfortunately, when those folks stop their spending, that's going to be a real drag to the economy. And so I imagine before we get this tariff issue resolved, we should have a couple of quarters of negative GDP growth, which will typically define a recession. I saw the funniest but most appropriate term this morning when I was reading Barron's. Have you heard about the taco trade? Which is appropriate because today is Tuesday and people like to talk about Taco Tuesday. The taco trade, that acronym stands for Trump always chickens out, which means in a good way. He may have a lot of bluster, but when he sees that his proposed 50% tariff on the EU collapsed the stock market last week, over the weekend, he turned around and said, oh, well, we're not going to do that until July. Keeps on pushing it down the road. But whenever one of these reversals in policies happens, the market rebounds. He sees that. And so he had shown with the tariffs on the Chinese that went from high to lower, with the tariff on the Eurozone, which went from higher to lower, that when the bond market gets hit and or the stock market get hit, he may do the taco. Trump always chickens out and gives us a chance to rally the stocks just based on his never mind. So anyway, I thought that was very, very interesting. And you know what? That's appropriate. So here's what happens. I think we're going to have another correction in tech stocks. I don't think it's going to be as steep as the correction we had in the overall market, which was about 21% from top to bottom around Liberation Day. I think we will have a correction between now and when the most tariffs go into effect, which is around the July 4th holiday. But because of the taco, we know that Trump won't let the market go down for too long or too far. I think we're going to have more of a garden variety correction of maybe 10 or 15%, not this real nasty truncated 20% in a whoosh drawdown that we had at the beginning of April. So before we move on, let's see if there's any questions out there for me. The motivator. What do you think about new? I'll look it up for you, man. because right now I don't have an educated opinion on it. I'm writing it down. Come back next week and I'll tell you at the tail. Oklo. I saw that Oklo had a nice surprise, not to be confused with Okta, but I haven't bought it yet. Good news on that front. Stock had spiked, but I'm watching it now. So if I was to put it in my Meeks, baseball team parlance, that would probably be on my watch list, right? My minor league ball club, maybe calling it up to the majors before too long. Thoughts on natural gas? I do like natural gas. I think in this country, too much investor attention is being paid to nuclear. But in the meantime, the only way we're going to build these AI data centers with their voracious demand for energy is through nat gas. So as I've told you, I do like nuclear long-term, but in the shorter term, I like the collection of stocks that are the natural gas plays, particularly as they do more deals with the hyperscalers and the other folks that are building massive AI data centers. Thoughts on Mongo? MongoDB, it's a good company, but the way I look at it is my preferred ways to play software right now and still benefit, like MongoDB does, from the AI trade is the momentum I see over at ServiceNow and SAP in the software space. I'd like to hear thoughts on more defense stocks like Lockheed and Raytheon, et cetera. I have held RTX for a while. So first of all, I do believe that some of these stocks have a role, and I do believe that they're techish enough so you can play, no pun intended, defense with defense stocks. But I will tell you, of your list, I've always preferred and do own RTX. How's the hip? Appreciate it. So here I am. I had surgery on the 13th of May. I quit my teaching post at the Citadel on the 15th of May, which was a big deal because I had been an adjunct or a full-time professor for 25 years. But my hip is feeling much better. Though I tell you, in a couple of hours, I'm going to have my 2-week checkup with a doc. Ask me next week and I'll know with certainty. Well, you guys, appreciate the questions as always. As you know, I'm super easy to find through Harvest Portfolio Management, through Benzinga, through my LinkedIn link where I have a lot of content. But stay tuned. Things are going crazy. Don't expect volatility to slow much. We're going to have high volatility as long as Trump is in the office. But that's also going to bring some great buying opportunities. And if you stay here, I will always, I'm a truth teller, tell you when to attack them and how aggressively. So next time, I look forward to seeing you back Tuesday, 11:30 a.m. Eastern. So for another week, here's Tech Tune Up with Paul Meeks, hosted with my friends at Benzinga.